and then it kind of just depends on how far we get through everything to see if we go till next Tuesday. I might do another one next Tuesday as well. We'll see. But again, as we jump into this, feel free to ask questions. I'll stop and answer as many as I can. But we'll kind of jump into it. And so today's review, oops, I think I'm on the wrong thing here. So today's review is going to at least cover these 4 topics. If we get through them faster than I anticipate, then we might cover a few more. But for now, these are the 4 that we're going to try to cover today. And so when we talk about current liabilities, I'm just going to be hitting highlights. And hey, Tammy, I don't want you to think of this as sort of like the only thing you should look at, but really what it is, it's a guide, and it's saying, okay, this is where you probably need to focus your attention. Make sure you understand and know this stuff really well. If I'm going over it, it's for sure going to be on the test, or very, very likely going to be on the test. If I don't go over it, it doesn't mean that it won't be. It just means that it's not going to be as emphasized. And so even in the examples, I'm giving you an example. Don't think of that as the only example. It's just an example of something you might see. And so don't limit all of your studying just to what we go over in the next couple, I guess it's going to be an hour or whatever, but it is definitely a good guide. And so let's start with the definition of a liability. If you remember, there are 3 elements to the definition of a liability. Most students kind of mistakenly just limit it really to the second element, which is that unavoidable obligation. They just kind of think, oh, it's something we owe. But it does have to have all 3 elements in order for it to actually be a liability. So there has to be a probable future economic sacrifice, if I could spell correctly. There must be a present unavoidable obligation, and there must be a past transaction or event. Hey, Lily. And so all 3 have to be there in order for there to be a liability. If any one is missing, then it's not a liability. And then probably the biggest example that we went over, and just one that I think lends itself to getting your feet wet in intermediate 2, is a short-term notes payable. And so they issue a $100,000 note. It's a 7% interest-bearing note. It's a 9-month note. They received $98,200 issuance, and there's a maturity in April 30th, 2021, and interest is not paid until maturity. If you recall, when you have a short-term note, you can use the straight line method to amortize discounts and premiums. If you have a long-term note, that is not an option. You must use the effective interest method. But for this example, because it's short-term, they can and do use the straight line amortization method. And so let's kind of walk through the journal entries related to this note. Again, just kind of rehashing the information. Hopefully the issuance is not too hard. They receive cash, $98,200. The note payable is carried at its face value of $100,000. And so if there's a difference between the cash issuance and the face value, that difference is a discount. And what that means essentially is the 7% interest in this case is insufficient to give the market what it desires, and so they're not going to give you a full $100,000, and so that's why it's being issued at a discount. And so when we walk through it, then we can see that any interest expense is going to be a function of both the cash payments, or whatever the interest is accruing contractually, and also the amortization of the discount. And we'll kind of see that starting in December at the fiscal year end. And so, of course, we do have to accrue interest payable. There's a 7% interest rate on the note. And, of course, 5 months have passed since its issuance. You have August, September, October, November, and December. And so there are 5 months. And so that's going to be a $2,917 credit. Now, before I jump into anything else, on your own, I want you to give me the entry amount, or try to come up with the entry amount for the discount. And so, again, going back to the original discount balance is $1,800. It's a 9-month note. And what I want you to do is give me the journal entry amount and whether it's a debit or credit for the discount. And so I'm going to give you, a few seconds here in the chat to give me that information, and then we'll kind of see how many of you got it right. So feel free to put it in the chat. If you're not that confident, then maybe you don't. I think you'll learn more if you actually type it out or say it out loud or something. But go ahead. What's the journal entry going to be for the discount? So Zuli says 200. Lily says 1,000. See if we have any more. Some people are faster with their calculators than others, or maybe more confident. Let me give you a hint. So John says 200. I gave you a little hint. So the discount amortization, you amortize over 9 months, but it's $200 what? Per month. So Zuli and John, I think you got the monthly amortization correct, but there's a piece of it that you're missing. So John said 83.33, and the answer is it's $200 per month, but it's 5 months. And so Lily got it right. It's $1,000, and the amortization is a credit. And so if 49er is issuing the note, it means they're going to actually be paying the note. And so it's actually not interest receivable, it is interest payable. If they had purchased the note, then it would be receivable. But they're issuing the note, they're agreeing to make a payment. And so the $1,000 credit, again, the normal balance in the discount is a debit balance, and so as you amortize that balance, it's going to be a credit entry. And so then when we get to our journal entry, we have the credit to our discount on notes payable, our credit to our interest payable, and from that we derive our interest expense as $3,917. Okay. All right, so now we have the maturity on April 30th, 2021. One part of that entry is going to be to remove the interest payable. Again, in the chat real quickly, if you can come up with some of the other account names that we're going to be included here. What are some other things that are going to be part of this journal entry? And even if you don't have to necessarily calculate amounts, we'll get there, but if you want to throw them in there, you can. But again, just what are some of the other things we have to be thinking about? Again, we have basically from January 1st until April 30th, and so there's this element of time passing, and usually in the context of debt, whenever we've talked about time passing, what is the account that we need to record? Note payable, cash, interest expense need to also be included. Good job, Arjun. Lily, interest expense, yep, exactly. All right, so we're kind of getting all interest expense, notes payable, good, Joanna. Right, so we got lots of things going on, and so let's kind of start walking through it. Of course, we do have to remove the note payable. That's a $100,000 balance, and so that's a credit balance, and so we need to get rid of it with a debit entry. We also have the discount amortization. Remember, we only amortized 5 months in 2020, so now we need to amortize the remaining 4 months in 2021, so there's going to be a credit to our discount. And then the cash payment, of course, is the face amount plus the contractual interest, and that $5,250 is 9 months of interest. And so if I take $100,000, multiply it by 7%, that's a total of $7,000, but that $7,000 would only be if the note had been outstanding for a full 12 months. It's only been outstanding for 9, and so the contractual interest is 9/12 of 7,000, which is 5,250. And so the total cash payment that 49er is going to have to make is $105,250. And then the interest expense is probably the one, as far as the amount, it's probably the one you most easily kind of mess up. And there's two elements to it, just like there was at the fiscal year end. There's the contractual portion, and then there's the amortization portion of the interest expense. And so for 2021, the contractual interest was $2,333. That's 4 months of contractual interest. And then the amortization, which we calculated before, was $800. And so the total interest expense for 2021 is $3,133 for those 4 months between January until April 2021. And so then we just put it into our journal entry. On April 30th, 2021, we have our interest expense. We're taking the payable off, both the interest and the note. We complete the amortization of the discount, and of course we have the cash payment. And so in total, it all kind of cinches up. And so again, that's kind of the biggest example as far as a problem is concerned in Chapter 13. So hopefully that's not too bad, especially because we've done a lot more complicated things since then. Hopefully it serves as a reminder more than anything else. We do also need to talk about payroll deductions. That was a big part of Chapter 13. If you remember, there's the Social Security withholding taxes. We commonly refer to that as FICA. There are two pieces of FICA. There's the OASDI, which is a 6.2%, but there's a cap. It's applied only to the first $137,700 of annual income for the employees, and that's the actually updated number for 2020. And so 6.2% of the first $137,700. And then the second piece is Medicare. Medicare is 1.45%, and there's actually no cap on that. Exactly. 2018 was a different amount, exactly. So every year, the amount continues to go up. Lots of reasons. The number one reason is Social Security is basically insolvent, and so they have to keep increasing the amount that they collect in order to keep it solvent. And so it's just going to keep going up every year. And so again, with Medicare, there is no cap. With OASDI, there is. And so you just have to keep track when you're talking about these types of problems. Keep track of how much income the employee has reported up to that date and figure out have we reached the cap or have we not. With Medicare, it doesn't matter, but with OASDI, of course, it does. And then there are payroll tax expenses. There's the federal unemployment tax, otherwise known as FUTA, and that's 6% applied to the employee's first $7,000 of annual income. Again, that's just part of the law. They can get a credit if there's a state unemployment tax up to 5.4%. So in most cases, the effective rate is actually 0.6%, because most states, given this federal law, will get the full 5.4%. With the state unemployment tax, or sometimes it's actually known as state unemployment insurance. Actually, in North Carolina, it's actually known as state unemployment insurance, and so they're synonymous. They're the same thing. It does vary by state. North Carolina, the cap for North Carolina is the first $24,300 of income. They actually haven't provided the new number for 2020. At least I couldn't find it, so it may be staying the same. And then, of course, there's also the employer portion of FICA, and it's calculated the same way as the employee withholding amount. Again, so that's just kind of a summary of the things we got to focus on when it comes to payroll deductions. All right, so now we're going to kind of look at a balance sheet here, and there are two ratios that we covered in Chapter 13. Both of them are important, and so we've got the current ratio. We're going to start with that one. Of course, the current ratio is all current assets divided by all current liabilities. And so in this example, there are 5 current assets and there are 4 current liabilities. And so the current assets are cash, short-term investments, accounts receivable, inventory, and prepaid rent. Land, equipment, and building are all non-current. And on the liability side, the accounts payable, salaries payable, honor and revenue, and short-term notes payable are all current. And then the bonds, common stock, and retained earnings are all non-current. And so the current ratio is just that ratio of current assets to current liabilities. So in this case, the current ratio is 3.06. On the test, if you need to calculate the current ratio, just round everything to the nearest hundredths place. All right, with the quick ratio, it's a little bit different. And so the difference really is in the numerator. And so in the numerator with the quick ratio, we only include cash, short-term investments, and accounts receivable. So we do not include inventory and prepaid rent with the quick ratio. The denominator is exactly the same. And so the quick ratio is going to be smaller than the current ratio. And in this case, it's 2.25. And so again, the quick ratio and current ratio, those were kind of the two big ratios we talked about. Oh, okay. So that is Chapter 13 in 15 quick minutes. Good evening, RF. Don't know who that is, but that's all right. If you have any questions, again, feel free to chime in. If you can be responsive to some of the questions I pose, that also would be really good. Hey, Marisol. That's okay. All right. Long-term liabilities. So with long-term liabilities, if you remember, there was a lot more calculation with this one, and the same is going to be true on the final. There's going to be some concept, but it's largely going to be calculation based. Yeah, Lily says chapter 13 was a simpler time. Isn't it funny how when you get to the end of intermediate 2, you realize, wow, what I thought was hard really isn't that hard anymore. It is kind of funny how that works. But there are three types of bonds that we covered. The simple one, of course, is where there's a par bond, and that's where the bond rate, the bond yield are the same, and the par value and the price are also the same. With the discount bond, that's a situation where the bond rate, and that's the coupon rate or the contractual rate on the bond, is less than the bond yield, and then the par value is going to be greater than the price. And then with the premium bond, it means the bond rate is more than the bond yield and the par value is less than the price. And so, again, that's just identifying the kind of situation we're in, whether it's a situation where you have a par bond or a premium or a discount. Yeah. Samantha, that's funny, and that, I mean, some students do, they thrive better, or maybe it's just a matter of better preparation too. We do need to make a distinction between interest expense versus the interest payment. With the par bond, they're the same. The interest expense and interest payments are exactly the same. With the discount bond, of course, the interest expense includes two elements. It's the interest payments, and it's also the discount. So in total, the interest expense is going to be more than the interest payments for a discount bond. With the premium bond, it's the opposite, the total interest payments minus the premium. That's also true of whenever we're accruing interest expense in any interim period. The interest expense for a discount is going to be whatever contractual accrued interest there is plus any amortization of the discount, whereas with the premium, it's any contractual interest minus any amortization of the premium. And so again, it's just kind of giving us context, again, trying to remind us of how these things worked. We're going to talk about effective interest amortization. I'm not even going over really straight line amortization because I kind of feel like that's pretty easy, and we just did it with the short-term note. So I thought we'd be better off spending some time looking at the effective interest method. And so we have a pretty simple example. 49er Company issues $500,000 of 5-year annual 7% bonds. The issuance takes place on August 1st, 2020. It's issued at 98, which means it's a discount. Interest is paid on July 31st each year. So provide journal entries for 2020 and 2021. And so we'll start with the journal entry for the issuance. Now, hopefully this one's not bad. So again, you don't even need time value of money or your calculator to do this, really. So the cash amount, of course, is 98% of the par value. So they're going to receive $490,000. The par value of the bond is $500,000. That's the amount we assign to the bonds payable account. And the difference between the cash that we raise and the bonds par value is that discount balance. And so the discount on bonds payable is $10,000 in this case. Okay, so now is when you get to pull out the calculator. And so let's see if you can solve for this. We're doing the TVM related to the bond, and of course it's a 5-year bond, so that's why our N is 5. The present value is the price, which is $490,000. The payment is the contractual obligation to pay interest, and then the FV is the par value. And so notice that the $490,000 is a positive because from 49ers' perspective, they're receiving that $490,000, whereas the $35,000 and $500,000 are negative numbers because those are payments that 49er is going to have to make. And so that's why we have to make sure we get the signs right. And so let's see, does anybody get a interest rate? So hopefully you've got your TVM calculator out and you can get a rate on this bond. 7.4943, that's Arjun's number. Ryan got the same. Natalia got the same. Yeah, we're all tracking there. That's good. So 7.4943%. Good job, Joyce, as well. Now, one question students have for the test is, where do I round? Honestly, like most of the time, if you round to the nearest hundredth, you're going to be okay. I always say it's kind of a judgment call. If we were doing a 10-year amortization, if you round it too much, it's going to cause some problems. But if it's like a 5-year, you're probably going to be okay if you round the percent to the nearest hundredth. And let's kind of jump then into the amortization table. Now, in this case, I kind of provided it for you. Not any particular reason, just to kind of save time, but I do want to highlight sort of how we came up with all the different numbers, just as a reminder. Again, you've done so many amortization tables since then that I hope this is really more of a reminder than anything else. Of course, the carrying value is the issue price. That's where we start. And notice the final carrying value is the par value, because that's where we're going to end up. The payments hopefully are fairly straightforward. It's an interest payment. It's the contractual interest payment. The interest expense, if you're going to get something wrong, that's probably where you're going to make the mistake. And you're taking the bond yield, which we just calculated on the previous slide, 7.4943%. And we're applying that percent to the carrying value. And so 490,000 times 7.49% is where we get the interest expense of 36,722. The amortization is the difference between the expense and the payment. Now in this case, it's a discount bond, so the amortization goes as an increase to the carrying value as the discount balance gets reduced. And so as amortization continues, of course, we get closer and closer to the carrying value. And if you remember the picture with the effective interest method, I don't know if you can see it in the picture here, but the curve kind of starts low and it kind of goes up at a curvature. So it kind of goes up at an increasing rate. And so I probably should have done that opposite. I just noticed in the video feed that it's opposite, but that's all right. Anyway, so hopefully you get all that information, and hopefully by now you know how to do an amortization table. Now, the next, we're only doing 2020 and 2021, so we really don't need the bottom half of that table. We really need the top half, and so I kind of highlighted it there for you. And so for the first journal entry, we're really focused on the first line, and so we're really looking at the 7/31/2021 row in the amortization table. The last interest expense is just the remainder. Yes, that is correct, Lily. Now, I put a little asterisk there because if you actually directly calculate it, you don't get exactly $37,298 because of rounding. I just put it there because it should be very close. But to make it work, you do just need to kind of plug in the right number. All right, so now for December 31st, 2020, we're kind of coming along, and what we have to do at the end of the fiscal year is we do need to accrue interest. And so there's the contractual interest. Again, the contractual interest is $35,000 for a full year, but since we issued this bond on August 1st, on 12/31/2020, we only have 5 months to accrue, and so that's where we get the $14,583, and so that goes as a credit to our interest payable. Now we're going to go back to the previous slide, and I want to see if anybody can get the rest of the journal entry. So what else do we're going to have the interest payable. What else are we going to have as part of our December 31st, 2020 journal entry? If you can give me an account and an amount, that would be great. So we know that the interest payable is based on the first column, and so now we got to figure out the rest of the journal entries for December 31st, 2020. And see if I'm going to give you a second here with this information and see if you can get it. Interest expense $15,300. Marisol, interest expense $35,000. Let's see if we have any other. Zuli, interest expense $15,300. Marisol, payment. Now I will say real quick, just to kind of cut that one off, there is no payment on December 31st. Remember, the payment is not made until July 31st. So there's definitely no cash transaction at the end of the fiscal year. Give it just a minute more. Lily, premium $718. And Lily, would that be a debit or a credit? And are you sure it's a premium? Remember, it was a discount. So John says 5/12 of 1722. I'm assuming you mean for the discount. Interest expense $15,300. Yep, Lily, that's all right. Discount will be a credit. I think we're getting pretty close. All right, I'm going to go ahead and scroll down. All right, so we do have to accrue the partial interest expense. the 36,722 times 5/12, and if 15,300, 15,301, that's the same. I would not count that wrong. I will say on the test, if it's a fill in the blank like a numeric answer, make sure that you round to the nearest dollar. Don't cut it off. So of course that the interest expense is a debit, 15,301. And then we have the partial amortization of the discount, the 1722 times 5/12, which is 718. And as Lily said, that is a credit. So we are going to credit the discount $718. And so then our journal entry, of course, is the interest expense, 15,301, the interest payable, 14,583, and the discount on bond payable, 718. So pretty good. I think most people were getting there. All right, so now the next journal entry is July 31st, 2021, and this is going to be recording the interest payment. Now, I gave you a couple here. You do need to remove the previously accrued interest payable, so you're going to get rid of that through a debit of 14,583. You also need to accrue the remainder of the interest expense. So the total interest expense for the year was 36,722, and so we need to subtract the 15,301, and so that interest expense is $21,421. And then what else is going to be part of this journal entry? So we know we have these debits. So what else is going to be part of this journal entry? What else do we have here? So again, July 31st, let's think about what needs to happen. So cash, good. How much cash, Julie? The remainder of the discount, also good, Ryan. Good, Lily. Yep, Natalia. Yep, the cash payment, good. So Ryan, how much of the discount? What's the remainder? So Joanna, credit, discount, and cash. Yep, Natalia, 35,000, good. Carolina, discount and cash. Good, I think we're tracking. This is good. So we do have to amortize the remainder of the discount, 1722 minus 718, which is $1,004 for the credit. And of course the cash payment, which is the $35,000 credit. And so there's our journal entry, 14,583, 21,421. Of course we just calculated those. And then we have the amortization of the discount and the cash payment. All right, so next journal entry is December 31st, 2021. Now we're shifting down on the row. And the reason we've done that is because the July 31st, 2021 journal entry completed that row, so now we have to move down. And so on your own, try to get the journal entry for December 31st, 2021. See if you guys can get that. And I'm going to leave up the amortization table because the information that you need is right here. In order to figure out what journal entry we need. And so again, if you get any account amount and the type of entry, feel free to type it into the chat. Again, this is just trying to make it as much like we would do in the real classroom as I can, but hopefully this is helpful. Again, I'm going to give it a few minutes to let you kind of work through it, see if you can get some numbers. Interest payable, 14,583. Very close. You say that's a debit, so I just want you to think about that for real quick, Lily. Think about the fact whether that should be a debit, the interest payable. See if anybody else wants to chime in. Yep. You are decreasing it. So the interest payable, well, you're decreasing, never mind, I jumped ahead. You would be decreasing the discount. So Zuli got interest expense, 15,355, the payable 14,583, and the discount 771. John got an expense 15,355. Yeah, we're accruing the interest payable, so we're increasing the liability, and then of course when the payment is made, that's when we would decrease it. Ryan got the same as Zuli. Good. All right, so let's kind of walk through it. Again, the same credit to interest payable. That doesn't change because the contractual payment doesn't change. Joanna got the discount at 771, interest payable 14,583, and interest expense 15,355. Good. I mean, we're really on top. This is really good. All right, I'll kind of move quickly. Again, we're partially accruing the interest expense, which is where everyone got the 15,355. And then we're partially amortizing the discount. That's where everyone got the 771. That's also a credit. And so again, we have all the information there: the partial contractual interest, the interest expense, and then the amortization of the discount. Very, very good. And so there's our journal entry. I just did a little bit of a rounding thing there because I think it's like 50 cents plus and minus, and so I just made sure that it fit. So the interest expense, in order to fit the journal entry correctly, I just made it 15,354. And by the way, on the test, don't worry about that kind of stuff. If there's some sort of rounding issue, I will absolutely take that into account. But good job. Good job. All right, long-term notes payable. The time value of money concepts and amortization are all the same as the effective interest method for bonds payable. I should say for, not or. So I don't really want to do another example just because it's exactly the same math as we just did. But I do want to quickly talk about notes in exchange for non-cash assets or services, just because I think this is something that some students tend to forget. But again, you have to ascertain the most reliable method to estimate the fair value of the note, the fair value of the asset or service, and the inferred or imputed interest rate to use in the transaction. So you kind of have to determine what is the most reliable way that I can do that. And if you recall, there were 3 levels: the level 1, level 2, and level 3. And so what you're trying to do is find another transaction, either a market-based transaction or even an internal transaction, where there's some transaction dealing with identical items, similar items, or of course there could be a situation where there is really no comparison and everything's unique. Most of the time with notes payable, at a minimum, you're going to have similar transactions. In other words, there's other debt transactions you can look at, and you can figure out the inferred interest rate on those debt transactions. So usually at a minimum you have a level 2. There might be situations where you don't, though. So the other reminder here is whatever method you determine is most reliable, you apply that to both sides of the transaction. In other words, let's say I'm exchanging a note for a trademark. Whatever I use to value the note, I'm going to use the same method or the same item to value the trademark. And so with the trademark, it's a level 3. And so no matter what you say the fair value of that trademark is, it's going to be less reliable than any way that I might use to value the note directly through a discount rate or something like that. And so I just want you to be aware that you need to apply it to both sides of the transaction. All right, so that's chapter 14. So now we're kind of transitioning into chapter 15, shareholders' equity. So that's 1/5 of the way done. Okay, not just for today, by the way. That's 1/5 of the way done for all of the review. All right, so with shareholders' equity, we're just kind of again be walking through concepts. The role of par or stated value for both common and preferred stock. So before I jump to that, does anybody know what is the role of par? When common stock or preferred stock has a par value, what does that mean exactly? And so just kind of put that in the chat if anybody knows. When you have a par value, what do we use that for? Why would with common stock and preferred stock? What's the role of par value? And see if anybody has an answer for that. Value of future cash flows. So Ryan has kind of a guess. You put the par into the stock account and the excess into the other one. Isn't it so when they repurchase it, it affects retained earnings? So the retained earnings, no, only if there's really no, I'm trying to think. When would it affect it? I don't think there's a situation where that would really affect what goes into retained earnings with when you're talking about a share repurchase. Because even if you were to retire the stock, that's only going to deal with the issue price. I guess the only marginal thing would be is if there was a large stock dividend. That'd probably be the only thing. An arbitrary value, yeah, yep. So Zuli's kind of on track there. Par goes into common stock. Everything goes got. Yep. Marcel's got it. Arjun. Yep. Most of the time it will Arjun. I mean, I guess if you issue it at par, then it wouldn't. But yeah, conceivably. I think everyone's onto it there. Again, the par amount is the amount that's assigned to the main account, common stock or preferred stock. And then any amount above par is going to be assigned to the additional account, the additional paid-in capital, either dash common stock or dash preferred stock. And so let's talk about stock and exchange for non-cash assets. Yep, good. So and again, like with all of these, just some of it's just a reminder, like, oh yeah, that's that account. It's not hard. It's just being reminded. Stock and exchange for non-cash assets or services. And again, this is the idea similar to what we just talked about. Again, you have to figure out the most reliable method to estimate the fair value of the shares and the fair value of the asset or service. And again, we have the level 1, level 2, level 3. And again, the most reliable method is applied to both sides of the transaction. Just so you're aware, sometimes the common stock or the stock might be more reliable than the other item. In other situations, the other item might be more reliable than the common stock. And so it's never one or the other. It's just which one's more reliable, and that's what you're going to use. All right, so a company issues 50,000 shares of common stock for $25 per share on January 1st, 2020, and the stock has a $1 par value. I hope by now these are very easy journal entries. Again, because it has a par value, we assign the par value to our common stock account, and then the amount that we raised above par goes into our APIC common stock account. And so the total cash raised $1.25 million, and we allocate it between common stock and APIC common stock based on the par value. I'm hoping that journal entry is very straightforward at this point. Let's talk about conversions. With preferred stock, remember one of the things that's an option with preferred stock is that it can be converted. So sometimes you might have convertible preferred stock. And so I'm just going through an example of this very quickly. Preferred stockholders convert 350 shares of no par preferred stock to no par common stock. On October 1st, 2020, the shares were issued at 102, and the conversion ratio is 5-1. Again, this is just rehashing how we do these conversions. And so, if 350 shares times $102 gives us $35,700. And so, whenever we make the conversion, that's the amount that comes out of preferred stock, and that's the amount that goes into common stock. Now, in this case, the conversion ratio of 5-1 really doesn't matter because both are no par. The only time that the conversion ratio really matters is if common stock has a par value. If it has a par value, then you really need to know how many shares are being issued. As a practical matter, obviously we want to know that there are 5 times as many shares being issued, but from the journal entries perspective, because there isn't a par value, it really has no impact on the journal entry. All right, so now this is kind of probably one of the bigger ideas in the shareholders' equity chapter, and this is dealing with Treasury stock. And so 49er Company repurchases 5,000 shares at $23 per share on August 15th, 2020, and another 2,300 shares for $29 per share on October 22nd. And so they've executed 2 share repurchases. And so maybe in the chat, you can, if you have time to do the amounts, great. But what's the debit and what's the credit? Whenever you have a share repurchase, you've got a debit and you've got a credit. Does anybody remember the accounts? And if you get the amounts, that'd be great. But I figure the amounts probably aren't that hard. It's just knowing which accounts go where. What account do we debit? What account do we credit? So Treasury stock, yep, Lily, that's one of the accounts. Is that the debit or is that the credit? Debit Treasury stock, credit cash, Treasury stock and cash. Yep. Debit treasury stock, good. Debit treasury stock, cash, good, Joanna. I think we're tracking. Billy, and cash, treasury stock, debit, cash, credit, good. Good, good, good. I think we're on it. All right, so for the first entry, the August 15th, of course, our treasury stock is debited $23 times 5,000 shares is 115,000. So we debit treasury stock, we credit cash. And then with the October 22nd journal entry, again, we debit treasury stock and we credit cash. Again, $29 per share times 2,300 shares gives us the second number. And so the total of 181,700 is correct. Of course, it would be two different entries, though. Okay, so we're going to reissue 2,500 shares for $31 per share on January 15th, 2021. And then another 3,000 shares for $15 per share on March 1st, 2021 as well. And so they're going to use the LIFO method. And if you remember the LIFO method, that's the last in, first out, which means that the shares that we're going to reissue first are those that were repurchased the latest. And so the latest repurchase was October 22nd. And so those are the shares we're going to reissue first. Once we reissue all of those shares, then we would get into the August 15th shares. Yes, you can abbreviate, absolutely. Any common abbreviation is just going to be fine. And so now, when we talk about the treasury stock entry, we have to think about the order, right? And so if there's a total of 2,500 shares, the shares that we're going to assume that we reissue first are the ones that were purchased at $29 per share. It would be specified. It won't always be LIFO. It could be FIFO as well. But the $29 per share times 2,300, and then of course there's 200 more shares, and that's where we use the $23 per share. And so the total entry amount for treasury stock is $71,300. And so we kind of do that entry then. We have our cash that we received, which was $31 times 2,500 shares. So we received $77,500. So that's going to be a debit. And then the treasury stock credit we just calculated, $71,300, and the difference goes into our additional paid-in capital dash treasury stock account. And so again, this is more as a refresher than anything else. Now the question is, how do we handle the 3,000 additional shares after that? And so again, the treasury stock entry, in this case, of course, we have the 3,000 shares, and the only shares we have left are those that were repurchased at $23 per share. And so it's a little easier calculation for a total of $69,000. And so again, the cash in this case, $15 per share times 3,000 shares, we receive $45,000, and then the entry amount for the treasury stock is $69,000. And what I've left blank here is the two in between. And so there's a difference here of $24,000. And so what do we have for our journal entry for those missing pieces? So notice there are two blanks, not to give you a clue here, but there are two blanks. And so in the chat, once again, if you can come up with the amounts and the accounts for the missing part of this journal entry, hopefully something will click there for you. So go ahead and try to take a shot at that. APIC treasury stock and retained earnings. What are the amounts for each, Ryan? How much treasury stock, APIC treasury stock, and how much retained earnings? And if you remember, just sort of as a concept, on the 115, on the January 15th, so Ryan says APIC for 6,200 and retained earnings for the rest. Yep, Lily got it as well. If you remember, the concept behind this is whenever the cash that you receive is more than the treasury stock amount, then that's thought of as a contribution. Essentially, you're having this transaction with your owners, and at the end of the day, they made a contribution to you. Yes, Natalia. Yep, good job, Natalia. And then in the second case, the cash that we receive is less than the amount that we have for our treasury stock, and so that's more like a distribution. And if you remember, the first thing that we distribute is any APIC Treasury stock, and in this case, the APIC Treasury stock account balance is $6,200. And then any distributions above that amount are distributed out of retained earnings, which is where the $17,800 comes from. And so everyone was on track there. So again, the first journal entry, the January 15th journal entry, that was really about a contribution from my owners, whereas on March 1st, 2021, that was more like a distribution from my owners, and so that's why they're a little bit different. All right, so another example here. This is really dealing with dividends, and so 49er Company has $25,000 common shares outstanding, another $500 in Treasury, and then 49er declares and issues a 10% stock dividend on October 14th, and then declares a 75-cent per share cash dividend on November 1st, with the date of record November 30th and payment date December 15th. And we have a par value, market price, all kinds of stuff going on. And so we're going to kind of walk through dividends, both stock and cash dividends. And so the first thing with the stock dividend, we're just going to kind of march through time. The number of shares that are going to be issued, if you remember, stock dividends only apply to shares outstanding unless it's a large stock dividend. Most of the time, a large stock dividend or a stock split will be applied to Treasury stock. Small stock dividends almost never are applied to Treasury stock, and so in this case you only apply the stock dividend to the shares outstanding. And so we will be issuing another 2,500 shares. The amount that we assign, if you remember, for a small stock dividend, we use the market price. If this were a large stock dividend, then we would use the par value. And so in this case, the share price, because this is a small stock dividend, is $20 per share. And so the entry amount for our retained earnings is $50,000. And so the $50,000 is a debit to retained earnings. And if you remember then, with the small stock dividend, in this case, we're kind of declaring and issuing on the same date. And so the number of shares that are issued are 2,500. The par value is $1 per share. And so the amount that we assign to our common stock account is $2,500. Any amount above par is assigned to APIC common stock. And so hopefully that makes sense. Again, if there had been a delay between the declaration and the issuance, remember we had that common stock dividend distributable account, and that kind of is the holding account until we actually issue the shares. But in this case, and on the test, I'm going to have it all happen on the same day if I do one of these problems. The next step then is to walk through the cash dividends. And so the first thing we have to figure out is what shares are participating in the cash dividend. Much like the stock dividend, the small stock dividend, only shares outstanding participate in the cash dividend. So we have the original 25,000 shares plus the 2,500 that we just issued, for a total of 27,500 shares. The amount of cash, the entry amount for retained earnings is the 27,500 times the cash dividend per share, and so the entry amount is 20,625. And so the first journal entry on the date that it is declared is the entry amount, again, 20,625. That's a debit to retained earnings. But because the payment has not yet taken place, we have the common stock dividend payable account, the 20,625. So that's how much we're now obligated to pay. We just haven't paid it yet. And so the next date is the date of record on November 30th, and there's no entry on that date. If you recall, that's the date that you figure out where you're sending the dividend, but there's really nothing of economic consequence on that date. You're just figuring out where you're sending the check. And then finally, on the date of distribution, that's when we take the payable off and we actually credit our cash for $20,625. And so, again, in this case, we had a declaration date, a date of record, and a date of payment. And just sort of recalling that the declaration date is when we debit retained earnings and have the payable. There's no entry on the date of record. And then with the issuance, that's when we actually, or the payment date, that's when we actually credit cash. So hopefully that one makes sense. All right, so now dilutive securities and earnings per share. If you remember this chapter, this is chapter 16, and this is where we had all of those different problems, and everyone kind of is like, man, I really ran into a time crunch. It's a lot to handle. Now the nice thing for the final exam is you're going to have your notes available to you, and so that will be helpful to remind you. But again, I would spend time reviewing this. I would spend time knowing how to do these so that when the test comes, it's not a matter of, boy, I need to learn this. It's a matter of, okay, I know how to do this. I just want to make sure I have the accounts right. Or I want to make sure I have a small part of this calculation right. But you should largely know what you're doing before you sit down for the test. And so this first example is a bond conversion. And so on January 1st, 2020, 49er Company issues 6,000 convertible 10-year bonds at 101. Each bond can be converted to 25 shares of common stock, where there's a par value here. And then on December 31st, 2021, 500 bonds are converted. And we're going to assume that 49er uses the straight line amortization for bond premiums and discounts, provide the journal entry for the conversion. So a lot going on here. But again, hopefully this is just more of a reminder. And so first of all, we do have to understand sort of what's going on because you have 6,000 bonds and not all of them are being converted. You really do need to understand what's going on a per bond basis. And so when we talk about the premium on the bond payable, the issue price was 101, which means that the premium on each bond is 1% of par value. And so that means there's a $10 premium on each bond. And that's just an important number to keep in mind. So we have to think about, well, what is the balance on December 31st, 2021 when this conversion takes place? Well, you would have been amortizing that premium. And so it would have been amortized in 2020 and then throughout the year in 2021. So there would have been the amortization of the premium for 2 years, which means that there are 8 years left on the balance. And so if the total balance is $10 and I still have 8 years remaining, the balance per bond is going to be 8/10 of $10 or $8 per bond. And so that's the balance in the account per bond. The bond's payable entry amount, of course, it's $1,000 par value per bond. There are 500 bonds that are converted, and so we're going to have an entry amount for the bonds payable of $500,000. The premium entry amount, again, we just calculated the per bond balance and we apply that to the 500 bonds, and so the premium entry amount is $4,000. And so those are the two, that's the first two parts of our journal entry. We debit our bonds payable $500,000 and we debit our premium on bonds payable $4,000. Again, the normal balance in each of those accounts is a credit balance, and so to get rid of the account balance, we need to debit those accounts. And so now we've got the second half of this, and we've got to figure out, okay, what's going on then? So they convert the bonds into common stock. And so what's going to be the other half of this journal entry? Well, we have the common stock account, and because there's a par value, there's going to be an amount above par, which is why we have the APIC common stock account. So let's talk about where the $12,500 came from. And so we know that we have 500 bonds. Each bond can be converted to 25 shares of common stock, which means in total there will be 12,500 shares of common stock issued when these bonds are converted. Given the $1 par value, the amount that we're going to assign to common stock is $12,500. And then the APIC common stock account is just a plug. So any amount above par for the common stock is going to be assigned to the APIC common stock account. So that APIC account is just a plug. So again, this is probably where we're going to be getting a little more tedious, and I totally get that. So if you have questions, feel free to shoot them out. But I'm hoping by walking through these examples, you'll just really get to refresh your memory. Okay. Next example. On January 1st, 2020, 49er Company issues 500 bonds. Again, $1,000 par value at 104. Each bond includes 8 detachable stock warrants with exercise price of $25 per share. The firm estimates that each bond has a fair value of $100 and each warrant a fair value of $5.25. Record the issuance, and then also record if 200 stock warrants are exercised on October 10th, 2021, again assuming that 49er stock has a $1 par value. Okay, so this is that bonds with detachable warrants kind of a problem, and so if you recall, there were two methods for doing this. One was the proportional method, and the other was the incremental method. And so the proportional method is if I can reliably estimate the fair value of both the bonds and the warrants. The incremental method would be if I can only estimate the fair value of one. And in this case, I do have the ability to estimate the fair value of both. And since I can estimate the fair value of both, I do need to use the proportional method. And so the way we do the proportional method is we figure out the fair value of each individually. And so we do have the fair value of bonds is $500,000. And then we have the fair value of the stock warrants. So there's a little bit of math here, not too big of a deal, but there are 500 bonds, there are 8 stock warrants per bond, and the fair value per stock warrant is $5.25. And so the total fair value of the stock warrants is $21,000. And so in total what we can see is that the fair value of the bonds and the stock warrants together is estimated to be $521,000. However, that is not the amount that we raised at the issuance. And in fact, what we raised at the issuance is $520,000, which is 104 applied to the 500 bonds. And so we have to allocate an amount to the bonds based on the relative proportion. And so the fair value of the bonds is 500. The total fair value is 521. That is the proportion that we're going to deal with. And then we take that proportion and we apply it to the actual proceeds from the issuance, in this case $520,000. And so we're going to allocate to the bonds $499,040 based on that proportion. We similarly allocate an amount to the stock warrants. We take the $520,000, which is what was raised. We multiply it by the proportion of the fair value that we had assigned to the stock warrants, 21,000 over 521,000, and so the amount that we allocate to the stock warrants is $20,960. And so if you notice in both cases, while we might have estimated a fair value for the bonds and the stock warrants, ultimately that is not what we assigned to each of those accounts. So as soon as we have these two numbers, the $499.40 and the $20,960, at that point now we ignore the fair values that we previously had used. They're no longer relevant to what we're doing. And so for our journal entry, we have a debit to cash of $520,000. We have a credit to our bonds payable of $500,000, and of course, with the bonds payable, the net amount that we assigned was $499,040. And so the face value or the par value gets assigned to the bonds payable account, and so that we have a net bond payable of $499,040, we do have a discount balance of $960. And then of course we have the stock warrant amount, which is that paid in capital account. Now remember that contribution, the $20,960, that was a contribution that bondholders made to have the right to exercise those stock warrants. Now, when they exercise the stock warrants, that's in a different situation. But right now, they've paid money just to have the right. And so that is a contribution that they've made as kind of quasi-owners, potential owners in the company. Hopefully that makes sense. So then the next part of the journal entry is the exercising of the stock warrants. And so I'm kind of walk through this again. First of all, we have to think about the paid in capital stock warrant entry amount. And so we know that the total that we allocated to the paid in capital stock warrant account is $20,960. And that represents 4,000 stock warrants. And the reason why we know it's 4,000 stock warrants is because there were 500 bonds and there were 8 detachable stock warrants per bond. And so there were a total of 4,000 stock warrants that were issued. And so the amount that we've assigned to each stock warrant is $5.24. And so what's going to be the entry amount then when we record this the exercising of 200 stock warrants? And so real quick, if anybody can kind of get that into the chat, what is going to be the entry amount, and is that entry amount going to be a debit or a credit for the paid in capital stock warrant account? Again, I'm going to give it a second here and see if anybody can think through what we would have there as a journal entry. And also, if you're able, are there going to be any, if you want to put it in the chat, if there are any other accounts that are going to be part of this journal entry. And so Lily says a $1,048 debit to the paid in capital stock warrant account. See if anybody else has an answer. Natalia got the same, 1,048. Natalia, do you agree that it's a debit? Maybe. Fair enough. Fair enough. All right. So there is $1,000, and so 1,048 is correct. Oop, I jumped ahead there. All right. Then common stock for 200, and the rest to APIC common stock. One thing you're missing, Lily, and I flashed it for a second, and that's the cash. So remember, they have an option to exercise these stock warrants, and so but to exercise them, they actually have to pay cash. And so the 200 stock warrants, when they are exercised, they have to pay $25 per share, and so they have to pay $5,000 cash. And so we have the $5,000 cash entry amount as well. But you did get the other two accounts correct. And so we have the $5,000 cash, the paid in capital stock warrant, $1,048. Both of them are debits. And then we credit common stock for 200, and then the amount above 200 we assign to APIC common stock, $5,848. But again, pretty good. Again, there's a lot of little details, but for the purpose of the test, they're not going to be really complicated. I'm going to kind of keep them simple. And again, you do have your notes to refer to, which is helpful. All right, so now the next one. I kind of combined them into one problem. So we're looking at stock options and restricted stock. And so the reason why I wanted to do that was just to kind of be a little more efficient. And so we have 20 executives. They have stock options. They have restricted stock. We have a fair value for each stock option, an exercise price, a market price for the stock. We've got lots of information. What's really important here is that both options and shares cliff vest after 2 years. We do have some employees that leave, and then we have some employees that exercise their stock options. And so now we're going to kind of walk through all these journal entries. And before we jump off, the only thing I want to kind of remember, kind of remind you that there's a distinction here, is whenever there's restricted stock, those shares actually get issued the moment that they're granted. And so they kind of sit in this trust where the employee really can't do anything with them until they vest. But there's actually an issuance that takes place. Whereas with the stock options, really nothing happens as far as an issuance until the options are actually exercised. And so the timing of the issuance is a little bit different depending on whether it's stock options or restricted stock. And so that's just something to keep in mind as we think about the journal entries. And so just to kind of give ourselves a perspective here, the total value of the stock options, and I'm going to do this per executive. And the reason why I want to do it per executive is because, we originally have 20, but then, a couple leave. And so there's some stuff going on that we just need to pay attention to. And so the total value of the stock options per executive, each one has 100 options, and the fair value of each option is $8.25 for a total of $825. And the total value of the restricted stock, that 15 shares, and in this case you use the market price on the day that they are granted. And so the $25 per share means that the total value of the restricted stock is $375. And so just kind of keep those two numbers in mind as we walk through things. And so the first thing we have to think about, if you remember this unearned compensation account, and so whenever we initially issue that restricted stock, there's two accounts that we have to deal with. One is the common stock account, and the other is this unearned compensation account. There is no par value, and so because there's no par value, I only have to worry about common stock. I don't have to worry about APIC common stock. And so we have our unearned compensation. Again, $375 is the value of the restricted stock per executive, and we apply that to the 20 executives who receive shares for a total of $7,500. Again, just reminding ourselves where that $375 came from. Okay, so then the journal entry is a debit to our unearned compensation and a credit to our common stock. And again, that unearned compensation is just kind of that equity account that kind of sits there until they start working. Because as they start working, that's when they start vesting. And so that's just kind of a holder there until they start working. So then we do have adjusting entries on December 31st, 2020. And so for the paid-in capital stock options, again, the value per stock option is $825. We still have 20 executives. It's a 2-year cliff vesting system, and so we're going to record half of that compensation expense in 2020. And so 825 times 20 times 1/2 is 8,250. We similarly recognize half of the compensation expense for the restricted stock by taking the 375 times 20 and multiplying it by 1/2. And so again, we have the amount of compensation expense for each item that we would record at the end of 2020. And so our journal entry is, again, the compensation expense in this case is a function of both the stock options and the restricted stock. In the case of the stock options, the account that we use is the paid-in capital stock options, and the unearned compensation is basically we're unwinding that temporary account, $3,750. Again, the idea here is that we're incurring an expense because of the work that they're doing, but we're incurring that expense, and their compensation really is in the way of ownership. And so that's why we have the credits to the paid-in capital stock option account and the unearned compensation account, because the value that they're receiving is in their role as an owner. And so rather than receiving cash or something like that, they're getting ownership. And so we're recording that. I'm going to pause there just for a second in case you're kind of feverishly catching up, because I want us to think about what we're going to do when 2 executives leave. Okay, so on February 1st, 2021, 2 executives leave, and we've got to figure out what to do about those 2 executives. First, we have our paid-in capital stock options and any related compensation expense for those stock options. So I'm kind of keeping those two together and saying, okay, well, in total they have $825. That's the value of the stock options. Of course, there are 2 executives. But with the stock options, remember, we have to think about what have we recognized. And the only thing that we've recognized is half of their total compensation. And so we did not recognize the full amount yet. And so we have to take the 825 times 2 executives, but we have to multiply that times 1/2, because I've only recognized the amount of compensation expense they had earned through 2020. I hadn't recorded anything in 2021. And so when I'm removing the effects from them leaving, I really only have to worry about half of the amount. So that's $825 total. With the restricted stock, it's a little bit different, because if you remember, I had issued the shares, and the full value of those shares was recorded. And so the $375 was the value of those shares, and we recorded the full amount for 2 executives for a total of $750. And so for the common stock, the entry amount for the common stock is $750. And what we've got to do with restricted stock is we've got to figure out, well, how much of that remains unearned, and how much of that has been recorded as earned, has been included in compensation expense. And again, this is a 2-year cliff vesting system. Half of it had been recognized as earned and half had not. And so that's why we take the $750 and we allocate half of it to unearned compensation and half of it to compensation expense whenever we take it off of our books. And so there's sort of 2 ways to handle it, right? The stock options are different than restricted stock. And so this is probably one you're going to want to review a little bit and just remind yourself, okay, that's how stock options work. That's how restricted stock works. And again, you will have examples to refer to on the test as you walk through the test. Okay, so now putting that all together, the paid-in capital stock options, that's the $825 that we had previously calculated. The common stock is the 750 that we had previously calculated. It's there in the second bullet. And then the total compensation expense, there's really two elements to this one. There's the 825 from the stock options, and there's the 375 from the restricted stock. And that's where we get the total of 1,200. And of course, the unearned compensation is the 375 that we had calculated on the first page. And so the total journal entry, there's a lot going on with this one. But hopefully you can see how it all comes together. And again, I know as I was creating these slides, I started to recognize that, man, Chapter 16 is just really detailed. But again, I feel more comfortable with it given that it's open note for you walking through this. If you could imagine for the students that did it in class who didn't have their notes, this was probably the section that they struggled with the most. But again, if there's any questions, feel free. Chat's a little bit silent, but I'm guessing you're just kind of absorbing at this point. All right, next problem. Earnings per share. Great, Lily. Thank you. Appreciate at least letting me know. Everyone's still awake. Earnings per share. This will probably be the last thing that we cover today. I think it's the last topic for Chapter 16. And so we'll transition. We'll wait for Thursday to jump through the rest of it. But 49er Company has 25,000 common shares issued, I should say, and outstanding on January 1st, 2020. There's a stock split, there's a repurchase, there's some net income, and there's some preferred stock. And so we're going to calculate 49ers basic earnings per share. And so the formula, hopefully you remember this formula, basic earnings per share is net income minus preferred stock dividends divided by the weighted average common shares outstanding. If you recall, the most challenging aspect of the basic EPS calculation is getting to that weighted average common shares outstanding. So in our example, the net income is given as 44,000, and then the preferred stock dividends, it's just 200 shares. The 5%, remember the 5% preferred stock is always applied to the par value, and so the dividend per share is $5. And so $5 times 200 shares is $1,000, and so that's where we got the $1,000. And so the last real kind of challenging piece of this is how do we get the weighted average common shares outstanding. And so if you remember, we had this table. And we kind of had 5 columns where we have dates, shares outstanding, which is actually the physical number of shares outstanding, any adjustment that needs to be made, and then the weight applied, and then finally weighted shares. And so hopefully this is like, oh yeah, I remember that now. But the dates and the shares outstanding, we're going to kind of start with that. And so kind of look for events, and the events here are April 1st and October 1st. And so that means we're going to have 3 different sections to our table. And so January 1st to March 31st is where there's physically 25,000 shares outstanding. And then on April 1st, there's a 2-for-1 stock split, which means we go from 25,000 to 50,000. And so from April 1st until September 30th, nothing happens. And so the physical number of shares outstanding remains at 50,000 shares. And then finally, there's a repurchase on October 1st, which means the physical number of shares outstanding goes from 50,000 down to 48,000. Now, what I want us to do on your own is we have this adjustment column, and this is where most students struggle the most. But what adjustments do we need to make? And so think about each row and think about the adjustment. And so on your own or in the chat, just kind of do them in order. So adjustment for the first row, second row, third row, and see if you can figure out what adjustment we need to make. See if anybody can get an answer here. So John, 200, 100, 100. Zuli, 200, 100, 100 as well. See if anybody else. Samantha, 200. Lily agrees, and Samantha, 200, 100. Good. Yep. everyone seems to agree, and that is correct. So 200% adjustment for the first row, and then 100 to 100. Everyone seems to agree that's good. And again, the idea here is stock splits and stock dividends require an adjustment, and you adjust any shares prior to the split. And so in this case, the only row that was prior to the split was the first one. And so that's why we need to adjust by 200% for that 2-for-1 stock split. Of course, if it had been a 3-for-1, then it would be a 300% adjustment. Hopefully just remember that part of it. And then the weight, hopefully that one's not too bad. Lily, didn't we start from the bottom and work up, just making sure? Yes, that is what we did. Now the way that I did it is, usually the way I think of it is if I have 10, or let's say just make it easy, if I had 10 shares on January 1st, how many shares would I have at the end? So kind of working my way through, on January 1st I have 10 shares. I would keep my 10 shares until April 1st. And as of April 1st, then I would have 20 shares because of the 2-for-1 stock split. And then October 1st, I would still have my 20 shares. And so that's why then the adjustment, if I end up with 20 and I started with 10, that's a 200% adjustment. And that's kind of how I'd worked through it. But that's where that 200% came from. Hopefully the weight's not too bad. That's just the number of months over 12 for each row. So 3/12, 6/12, and 3/12. And then if you remember, we multiply across. And so we take 25,000 times 200% times 3/12, and then 50,000 times 100% times 6/12, and on we go. And so that's how we get our weighted shares for each row. We multiply across, and then we add up to get our total weighted shares, which is our weighted average common shares outstanding then would be 49,500 shares. And so jumping then to our basic earnings per share, we have the numerator already, and now we have the denominator, 49,500 shares. And so our basic earnings per share then would be 87 cents per share. And if you remember, when we're actually reporting, we always round to the nearest penny, and we always identify earnings per share as dollars per share. Okay, so now we're going to take that information that we just did. So we have our basic earnings per share. And now we're going to have some other things. And this is getting to our diluted earnings per share. And so we has employees that hold 3,000 stock options that have not been split adjusted. And it gives them the right to purchase common shares at $10 per share. And 49ers stock is trading at $8 per share throughout the year. In addition, each preferred share is convertible to 7 common shares. So I just introduced 2 elements to this. So again, stock options and convertible preferred stock. And so remember, the stock options, we had to think about, are the stock options in the money or are they out of the money? And so we talk about the 3,000 stock options with an exercise price of 10. It's really important to note that that's not split adjusted. And so with the 2-for-1 split adjustment, instead of having 3,000 options at $10 per share, you'd have 6,000 options at $5 per share. And so their exercise price of $5 per share is less than the market price of $8 per share. And so in that case, that means those options are in the money. And if they're in the money, that means they're going to be dilutive. If they had been out of the money, then they would be anti-dilutive. But these are in the money, and so we need to include them. And so the number of shares issued, again, is doubled. So it's the 3,000 that were part of the original contract, but we have to multiply it by 2 in order to split adjust the options. And so 6,000 shares are going to be issued. The cash that they receive, again, it's split adjusting the price, the exercise price. And so 6,000 shares times $5 per share means that the stock options, the company would receive $30,000 cash if those stock options were exercised. We take that cash and we figure out how many shares they could repurchase. So we take 30,000 and we divide it by 8. Which means that there would be 3,750 shares repurchased. And so you can see there are 6,000 shares issued and 3,750 shares repurchased, which means that the net shares issued is 2,250 shares. So then after that, we have a new earnings per share. The numerator does not change, But within the denominator, we need to add 2,250 additional shares. And so the total number of shares when we're calculating our new diluted earnings per share is 51,750 shares. And so the new earnings per share, the new diluted earnings per share, is 83 cents per share. And again, hopefully if you remember that, just kind of walking through, is it in the money? If it's in the money, how much cash did I get? Have to do repurchase, all that kind of stuff. So now we're going to deal with the convertible preferred shares. Again, with this one, if you remember, when we have conversions, I'm a big fan of having that change in the numerator over the change in the denominator to figure out if it's dilutive or potentially dilutive or if it's anti-dilutive. And so in this case, when we talk about the convertible shares, the first thing is they don't have to pay the dividend. And so the numerator of our earnings per share calculation would increase by $1,000. But at the same time, of course, they're issuing common shares. And so there would be a change in the denominator as well. There are 200 preferred shares, and the original contract allowed them to be converted to 7 common shares. But remember, that was not split adjusted. And so after the split adjustment, they can actually convert to 14 rather than just 7 shares. And so the change in the numerator is the increase of 1,000, and the change in the denominator is an increase of 2,800. And so the effect from the conversion is 35.7 cents per share. And if you remember, what you have to do is compare that EPS effect to the new diluted earnings per share. And you can see that the new diluted earnings per share is 83 cents per share, and the EPS effect is 35.7 cents per share, which means that this conversion is dilutive, which means it needs to be included in our diluted earnings per share calculation. And so when we do that, we have again an increase in the denominator and an increase in the numerator. And so the new numerator is 44,000, and the new denominator is 54,550 shares. And so our final diluted earnings per share is 81 cents per share. And that is all. So I want to leave a minute here. If there are any questions or anything you want me to go back to and re-explain, I'm more than happy to do that. So how did we get the 1,000? We go all the way back. So the 1,000 was part of our basic earnings per share. And if you remember, that was our preferred stock dividends. And that was from the information above, that it says there's a 200 shares of 5% preferred stock where there's a $100 par value. So the dividend for each preferred share is $5 applied to the 200 preferred shares, which means the preferred stock dividend is 1,000. And so if they convert all those shares, I no longer have to pay that preferred stock dividend. And so that's why there's an increase to the numerator of $1,000. Did that make sense, Zuli? Good, good. Yep. Any other questions? Marisol, I missed how we got 3,750 shares. Let me go. The 3,750. Okay, so that's right here. And so the whole idea is under U.S. GAAP. So with the U.S. GAAP, we assume that we're going to repurchase shares with any cash that we received. And so we received $30,000 cash, and the average share price was $8 per share throughout the year. And so we take the number of the cash that we have, divide it by the price per share, and that gives us the number of shares that could be repurchased, which is where the 3,750 came from. And then Samantha had asked about the APIC on the Treasury stock. You're welcome, Marisol. Let me go all the way back. Shouldn't take too long. All right. So whenever we reissue shares, the APIC Treasury stock, if we kind of think about the January 15th, 2021 entry, the amount of cash that we received was $6,200 more than the cost of the Treasury stock that we had repurchased. And so the idea there is anytime the cash that you receive is above your cost, that's an additional contribution. And we take that contribution and we put it into our APIC Treasury stock account. And so that's where the $6,200 came from. And then when we go to reissue shares, any subsequent reissuances, whenever we have a difference between the cash and the treasury stock, in this case, if the cash is less, we think of that as a distribution. And so when you have a distribution, the first thing that you distribute is APIC treasury stock. And then anything above APIC treasury stock, once APIC treasury stock is exhausted, then distributions come out of retained earnings. And so that's why the 6,200, hopefully that explains where we got it in the first place, and also explains why that's going to be a debit in the second journal entry. What will the format look like for these questions on the test? There's really kind of a mixture of format. I will be uploading these slides, Marisol. As far as the format, there's really going to be a mixture. There's a few multiple choice. There's some true false. There's fill in the blank. There's calculation based. There's a few journal entry type questions. There's not going to be long problems though, so it's not going to be like a 5-step problem. Nothing like that. So, and so for each of these, just think about a simplified version of it or a piece of it, but not all of it all at once. And so it's generally, I don't think there's any problem that in and of itself is worth more than like 5 points on the whole test. And so each one is kind of a small snippet. And so I didn't want like a 15-point workout. No, nothing like the statement of cash flows. And we'll go over that. We'll go over kind of what you need to know for the statement of cash flows on Thursday, if we get to. I mean, Thursday or next Tuesday, one of those 2 days. Sorry, my 10-year-old's waving at me. I'm streaming. I don't think you want to be on the camera because you just woke up. You can come. It's fine. Oh, there we go. Good. The final is on the 7th at 8 a.m. Yes, so the way that I built it is you have 150 minutes to take the final. It opens at 8. Lily says hi. You can say hi if you want.
Hi.
Probably can't hear you. You can hop in here. You want to?
Sure.
Okay. This is my youngest. He's 10. Oh, he's the baby.
Just get the chair.
It'll pop in a second. Anyway, so final is at 7 at 8 a.m. Yes, so at 8 a.m. You have 2.5 hours, so 150 minutes. But just remember, the one thing that I did last time, that I didn't do last time, that I'm going to do this time, is I'm going to leave the window open a little bit longer. So if you can't start right at 8 a.m., you'll still have 150 minutes. I think I cut it off completely at 11:30. Everybody's saying hi to you. I cut off completely at 11:30. So if you want the full 2.5 hours, you need to start by 9. So you just need to make sure you start by 9. Ha! I will say, Zuli, of all my kids, this is the most likely one. He's a math genius. They're all saying hi to you still.
Yeah, I know.
They're not saying hi to me. I'm not as cute as you. Any other questions? You can say hi.
Hi.
He can probably hear you. All right, everybody. Well, if you do have any questions, feel free to email me. And we'll do this again on Thursday. Yeah, they can hear you. Good. We'll do this again on Thursday. I don't know if Levi will be featured again, but that's all right. All right. Have a good one, everybody. I appreciate it. Keep hanging in there. Study hard. Email me if you have any questions. You're welcome. You're welcome. You're welcome. Thank you, everybody.